Welcome back to Talk Tickers. If you are tuning in right now, you are looking for the signal in the noise of earnings season. We are your professional earnings call summarization source. And folks, today we have an absolute monster of a quarter to get through.
It really is a monster. We are diving deep into the Travelers Company's ticker, TRV. They held their Q4 2025 earnings call yesterday, January 21, 2026. And I have to say, this was one of the more interesting disconnects I've seen in a while.
A disconnect between what?
Between the company's performance and, the market's reaction.
Right, because usually when we talk about insurance, excitement kind of goes to die.
Yeah.
We expect actuaries, risk tables, maybe a boring discussion about bond yields.
Exactly.
But this felt different because of the sheer magnitude of the numbers versus what the stock did. We had a massive beat on the top line, a massive beat on the bottom line. Management was practically doing a victory lap.
And yet, if you pulled up the chart yesterday, you'd think they just, met expectations and went home. The stock was flat in pre-market. It barely ticked up, maybe 0.4%, maybe up to 1.8% during the session.
Just a completely muted reaction.
Incredibly muted for what looks, on paper, like a blowout quarter.
That is the mystery we need to solve today. How can a company crush estimates by nearly $3 a share and just get a shrug from the market? Is the market missing something? Or are the numbers, are they lying?
Well, it really comes down to understanding the quality of the earnings. Where did the money actually come from? Was it skill or was it just, look with the weather?
Okay, let's unpack this. We have to start with the headline numbers because crushing estimates feels like an understatement here. Walk me through the EPS.
Let's look at core EPS earnings per share. The consensus estimate from the street was sitting around $8.34.
Okay, $8.34.
Pretty standard. Travelers came in and dropped a core EPS of $11.13.
Hold on. That's a beat of almost $3 a share. In the tech world, that happens. But in the insurance world, that is usually a sign of some one-time tax credit or an accounting gimmick. Was this actual operating profit?
It was real. And it came from everywhere. Revenue hit $12.432 billion, beating consensus by over $1.3 billion. That's up 4% year over year.
Okay.
But the number that really matters, the holy grail for the insurance nerds, is the combined ratio.
Right. Let's pause there for the listeners who haven't looked at an insurance balance sheet since college. What specifically are we looking at with the combined ratio? Why is that the metric?
So think of the combined ratio like a dollar bill. It measures how much money goes out the door for every dollar of premium that comes in. If the ratio is 100, you're breaking even.
Taking in $1, paying out $1. Simple enough.
Anything under 100 is pure profit on the underwriting, so lower is better.
Much better.
And Travelers posted a stellar 80.2%.
80.2%.
Yeah.
So for every dollar they took in, they kept almost 20 cents as pure underwriting profit.
Exactly. That is an elite number. That is a money printing machine. And even if you strip out the noise, the reserve development, the catastrophes, the underlying combined ratio was 82.2%.
So the core business is just incredibly healthy.
Very.
Okay, so we have an 80.2% combined ratio, an $11 EPS print. Why the long face from the market? Why did the stock barely budge?
It's a phenomenon we call cat normalizing.
Cat normalizing. Okay, break that down.
Investors look at Q4 and say, okay, you made a ton of money, but you also got incredibly lucky with the weather. Catastrophe losses were only $95 million pre-tax. For a company the size of Travelers, that is, it's virtually nothing.
I see. So the market is looking at that $11.13 EPS and saying, yeah, but if there had been one bad winter storm or a freeze in Texas, that number drops significantly. They don't believe it's repeatable.
Precisely. They are discounting the beat because it was aided by a benevolent Mother Nature. They are fading the result. But, and this is where it gets fascinating, if you ignore the weather and just look at how they are managing their capital, the story gets very, very aggressive.
Let's talk about that aggression. Because while the market was yawning at the EPS, management was busy doing something very interesting with their cash pile.
This is the buyback bonanza. The board authorized an additional $5 billion in share repurchases.
Okay, but authorizations are cheap. Companies authorize buybacks all the time and never use them.
Right, but Travelers is not waiting. In Q4 alone, they bought back $1.653 billion of their own stock.
That is a massive number for one quarter. And they aren't slowing down, right?
Not at all. CFO Dan Frey was very clear. He indicated they expect to do about $1.8 billion in repurchases just in the first quarter of 2026.
$1.8 billion in 3 months. That's immense velocity. Where's all this cash coming from? I know they're profitable, but that is a lot of liquidity to burn in 90 days.
Well, they had a specific liquidity event. They sold their Canadian operations, and that deal just closed on January 2nd, 2026.
Okay, so they sold off a business unit.
But think about the strategy there. They sold a business unit, Travelers Canada, basically trading a stream of future operational earnings for a lump sum of cash right now.
Okay, so they cashed out.
They cashed out, but then they immediately turned around and are using that cash to buy their own stock. They effectively said, we think our own shares are a better investment than the Canadian insurance market. It's a form of asset arbitrage.
That is a massive signal of confidence. They are shrinking the float, boosting the EPS even further.
It signals immense confidence in their U.S. valuation. And it's not just the buybacks. The investment income tailwinds are really kicking in. You have to remember, insurance companies are basically asset managers disguised as risk takers.
Right, they hold all this premium, the float, and invest it.
And with interest rates where they are, that float is generating huge yield. After-tax net investment income, or NII, hit $867 million in the quarter, up 10%. But look at the guidance. They are forecasting $3.3 billion in fixed income NII for the full year of 2026.
So that is just steady cash flow hitting the bottom line, regardless of whether the wind blows or the earth shakes.
Correct. And there was a subtle little nugget from the CFO regarding their debt strategy. Did you catch that?
I saw it in the notes. Something about changing the schedule.
Yes. Historically, Travelers would issue debt every other year. Now, Frey says they are moving to issuing debt annually.
Why does that matter? That sounds like boring corporate housekeeping.
It is boring, but it matters. It's about maintaining a consistent debt-to-capital ratio as they grow. It smooths out their capital structure. It signals that they are maturing into a consistent compounding machine. They are optimizing the balance sheet to support this massive capital return program.
So we have a cash machine. But usually when we talk about big legacy insurers, we think of old mainframes, paper files, slow processes. But CEO Alan Schnitzer spent a lot of time on this call trying to reframe Travelers as a tech company.
He did. He framed the last decade as Innovation 1.0, which was about fixing the plumbing. Now he says we are in Innovation 2.0.
And of course, that means AI. Every CEO in the S&P 500 is saying AI right now to pump the multiple. Was there actual meat on the bone here, or was it just buzzwords?
It felt surprisingly tangible. Usually you hear, we are exploring generative AI capabilities. Travelers came out and said, we have an Anthropic partnership.
Anthropic. That is a serious name to drop.
It is. They're empowering 10,000 engineers and analysts with these tools. But more importantly, and this is what separates the buzz from the business, they are showing results in the headcount.
This is the part that jumped out at me. They mentioned the claim call center population.
More by 1/3.
1/3. That is a massive reduction in human capital for a service-heavy industry.
It's huge. And they are consolidating 4 claim call centers down to just 2 this year. This isn't theoretical efficiency. This is real estate leases being canceled and payrolls shrinking.
And they launched a voice agent too, right?
Yep. Just last week, a natural language Gen AI voice agent that handles first notice of loss calls. So when you get in a fender bender and you call Travelers, there is a good chance you were talking to an AI.
That is wild. But let's connect this to the financials. Did this actually move the needle on profit, or is it just cool tech?
This hits the so what of the tech talk. Efficiency in claims handling lowers your loss adjustment expense, or LAE.
Okay, break down LAE.
The LAE is a huge part of the combined ratio. It's the cost of processing the claim, not the claim itself. So if you use AI to cut the cost of handling a claim, you are permanently improving your profit margin on every single policy you write. That's operating leverage.
So it effectively lowers their break-even point. They can make more money at the same pricing level as their competitors.
Or they can price lower and still make the same margin. It gives them a strategic moat.
Let's look at the specific segments because the Travelers umbrella covers a few different businesses. Business insurance is the big engine here.
It is the engine, and it is humming, underlying combined ratio of 87%. But the most interesting dynamic was in national property.
What happened there?
Premium volume actually declined.
Wait, premiums went down. Usually on these calls, CEOs are apologizing if growth slows down.
Not here. Management explicitly said they refused to write business at unfavorable terms. They saw the market getting soft or irrational in certain spots, and they walked away.
That is the definition of discipline, walking away from revenue because it's bad revenue.
Exactly. It's manager of the year behavior. And excluding that property line, renewal premiums were still up 8%. So they're getting price where they want it and shrinking where they don't.
Then we have personal insurance. This is your car and your house. For a while, this is the problem child for Travelers.
It was the problem child for the whole industry. Inflation, repair costs, used car prices, it was a mess. But this is the turnaround quarter. Segment income was over $1 billion just for personal insurance.
And the combined ratio for homeowners, I had to double check this number, 60.3%.
60.3%.
Yeah.
Now, again, we have to be honest, that is heavily aided by the lack of hurricanes and wildfires in Q4. You can't expect 60% every quarter.
Right.
But even in auto, which is less weather dependent, the underlying combined ratio improved 4 points to 92.2%. They are fixing the car insurance business.
That is significant. Now, I want to touch on reinsurance. We talked about how investors are cat normalizing the results, worried about the next big storm. It seems like Travelers is worried about that too.
Or at least preparing for it. They made a very strategic move for 2026 regarding their reinsurance treaty.
Okay, let's explain this simply. Reinsurance is just insurance for insurance companies, right?
Exactly. Travelers insures your house. But who insures Travelers? Reinsurers.
And they changed the attachment point. Translate that for us.
Think of the attachment point like a deductible. Before, Travelers had to pay the first $4 billion of catastrophe losses out of their own pocket before their reinsurance kicked in. Now, for 2026, they lowered that deductible to $3 billion.
So they are passing the bucket $1 billion sooner.
Exactly. If a massive hurricane season hits, their reinsurers start paying out $1 billion earlier than they would have last year.
That sounds expensive. Usually, lowering your deductible raises your premiums significantly.
That's the kicker. Management claims it came with only a modest increase in cost.
If that's true, that is a masterstroke.
It is. They are using their financial strength to cap their downside volatility. It makes the earnings more predictable. It's like they're building a fortress. They have the AI lowering expenses inside the walls and the reinsurance strengthening the walls from the outside.
But it's not all blue skies. We have to look at the macro context. CEO Schnitzer brought up tort inflation.
It's a perennial headache. Social inflation is another term for it. Juries handing out massive awards. Schnitzer said it remains challenging, but he did note that some states are finally reacting because it's making insurance unaffordable.
And then the other elephant in the room.
Tariffs.
With the geopolitical landscape shifting, everyone is worried about the cost of parts for repairing cars and homes.
Right. If tariffs go up, doesn't the cost of a bumper go up? But this was surprising. Management said the impact of tariffs on loss costs has been negligible so far.
Oh, yeah.
Less than even their modest provisions. Basically, they priced in a buffer for tariffs, and they haven't even needed it yet.
So let's summarize the bull case and the bear case before we get to our trade idea.
The bull case is the flywheel. You have rising fixed income yields giving you billions in free money. You have disciplined underwriting keeping the combined ratio low. And you have this aggressive share count reduction, that $1.8 billion buyback in Q1.
You effectively have a company shrinking its share count while growing its earnings power.
Exactly.
And the bear case.
The bear case is just weather. The 2026 catastrophe plan assumes a higher load than the 5-year or 10-year average. They are explicitly telling us we expect bad weather. And historically, Q2 spring storm season is the largest CT quarter.
Right. You were buying right before tornado season.
Exactly.
That is the fundamental landscape. But now we move to the part of the show where we take off the analyst hats and put on the hedge fund pod hats.
Let's do it.
This is not financial advice segment. We are going to pitch a trade that is a little wild, a little aggressive, but based on the data we just discussed. What do you have for us?
I call this trade the claims bot arbitrage.
I love the name. What's the setup?
The setup is go long Travelers, ticker TRV, and short a basket of pure play insurtechs or maybe some legacy carriers with really high expense ratios.
Okay, long the incumbent, short the disruptors. Why?
Because Travelers has flipped the script. Usually the thesis is that you short the dinosaur because the tech companies are going to disrupt them with efficiency. But Travelers just told us they cut call center staff by 33% and consolidated real estate because of AI.
They're the ones doing the disrupting.
Exactly. They're effectively converting AI efficiency directly into share buybacks. Think about the mechanics. They implement Anthropic. They cut costs. That cash goes immediately into buying back stock, $1.8 billion of it in Q1.
It's a cannibal strategy.
It is. They are eating their own shares with efficiency gains. Meanwhile, a lot of the insurtechs are still struggling just to get their combined ratios under 100. Travelers sitting at 80.2%.
And the kicker is that liquidity from the Canada sale.
Right. With the proceeds from the Canada sale and that lower reinsurance attachment point, they have they floored their downside. If you short the high-expense players against this, you are betting that scale and data win the AI war, not just a cool user interface.
That is a compelling pitch. You are betting on the boring bot to win.
I am betting on the cash flow velocity. The market yawned at this report, but if they execute that $1.8 billion buyback in Q1, the stock price has a relentless bid underneath it.
It's the bid that doesn't sleep.
Precisely.
Well, there you have it. A deep dive into Travelers Q4 2025. A boring, but a beautiful beat.
Excellent underwriting, massive capital return, and genuine AI integration, actually reducing costs.
The market might have yawned, but the cash flow is screaming. As always, this was not financial advice. Do your own diligence. Don't blame us if the weather turns against you.
And watch that Q2 storm season.
We will see you on the next ticker.